get started. How many of you know what this class is about today? Oh, there you go.
Okay.
How many of you are like, I'll just think I'll hang out and stick around after Cameron's awesome class? So this is going to be a cool conversation, and I'm excited to have both Amy and Miles here with us today. And we're going to be talking about real estate investment trusts. And then also, if we have some time, we'll talk about syndications, which is a little bit different. And just helping you to understand different investment avenues that are out there, but also how you might be aware of these even with conversations with your clients, right? Just have enough contextual awareness to where if a client brings it up and you want to have a conversation where you seem knowledgeable and understanding of what these are, how they work, you can at least hold your own ground with this topic. So excited to have these two come up, and I'll let them give a little background. Amy, if you want to maybe introduce yourself, Miles, and we'll get started.
Yeah. I'm Amy, Kendall. I'm going to stand this way because on my way to get coffee this morning, I had a wardrobe malfunction and my sweater ripped. So I'll stand this way. So I'm Amy, Kendall. This is my husband, Miles. We've been married for 20 years. We've been investing for 15. Well, more than that, but we bought our first investment property in 2010, 2005, and actually started renting it in 2010. So we've owned properties for a long time. We have diversified over the years just through different types of real estate investing. We've done some syndicating. We've done the real estate investment trust. This class happened because so we on the More Club chat, someone asked, hey, does anybody do this? And I was like, oh yeah, we do. We have a couple. I don't have all this ton of experience, but we've definitely used it to diversify. So we kind of got nominated to teach a class. So well, hopefully it's not disappointing. We're going to try and get through a lot of the content. We don't have it. It's not like super in depth. We're going to try and get through it just so that it can be more of a more interactive, just more conversation, questions, kind of just share our experience with stuff. Obviously, we'll go through the boring stuff too. I really wanted dancing skeletons in some sort. I get really bored with like a regular PowerPoint. Do I use this?
Yeah.
And then just up and down. Okay. So I get super bored. I tried to add fun things and it just didn't work out for me. I'm not a PowerPoint expert, unfortunately. I did try. So let's see. No? Oh, this one. Power. Well, maybe we're going to have to do it from memory. It says on. Should we restart it? Seems that there isn't a better way.
Cam stole the data.
He's right. Just trying to set you up with that.
It's not hard.
Yeah, that's it.
Nice. Thank you. It just switched the whole thing out. Okay. So REITs, does anyone know about REITs? I'm assuming a little bit since you guys came to this. There's basic criteria for REIT. So they're real estate investment funds. You can invest in them with very small amounts of money. So where regular real estate investing, you'd have to, either partner or you have to come up with a down payment one way or another. So this would offer, a different avenue where you don't have to come up with a huge down payment for real estate. So they're traded publicly or privately. They have to follow the IRS rules. Those are the rules. 75% of the assets must be in real estate, cash, or treasuries. 75% of the gross income must come from a real estate source. So it has to come from like rent, interest on the real estate loan, or if they sell the property. And then they have to distribute 90% of their taxable income to the shareholders. So 90% of what they're making has to go to you. Into REITs. No, I think you have to do it through what is it's another designation. I can't remember. Does anyone remember what it is?
You said.
The Delaware Trust. Yeah. That's what it is. So no. Oh, wrong way. Yeah, they're securities. So there's different types of REITs. We have experience in equity and mortgage REITs, which we'll talk about in a little bit. The equity REITs are they own the real estate, they own apartments, shopping centers, warehouses, all that. So they actually own the real estate. Mortgage REITs obviously own mortgage-backed securities. Those are some examples of each of the different types of REITs. There's tons of them. And there's lots of YouTube videos on all the different types of equity REITs or mortgage REITs. Mortgage REITs are they're pretty complicated. So we dug into a rabbit hole on it last night, but they're interesting. They return a little higher because they're a little more risky. So just like real estate with high risk, high reward kind of stuff, it's pretty comparable. And then hybrid REITs would be a mix of both equity and mortgage REITs. I don't know how many slides. How many slides is that? 4? So we'll talk a little bit about the differences between investing in a REIT or your own residential or multifamily or industrial, any kind of real estate investment that you've got. So it's really predictable. So if you own your own rental properties, you probably know you can have really good years and then you can just have bad years. And so it's just it's a lot more predictable. So even though your interest, the dividends that you receive, the interest on them changes a little bit, it's just a more stable, predictable cash flow in your portfolio versus like, oh, hey, this year you ended up replacing a dishwasher and an air conditioner and your roof. You know what I mean? And then over time, if you hold that property, obviously your returns are going to even out. But if you're just holding those rental properties in your own portfolio, depending on timing, those returns can be a little different. So more predictable cash flow from that. You're not actually replacing the dishwasher yourself, so it's not money out of your pocket. And then compound returns, that can be a little tricky. You can get really complicated with what you do with the money that you make off of the returns from the dividends. Most people, or a lot of people, reinvest what they get, which would be no different than, like stocks. If you're investing in stocks and you get you sell some of them and reinvest again, you can do the same thing. So you can reinvest the money that you're making back into the fund, to compound your return. Reduced volatility. So this one is related more to the dividend paying stocks. So what we mean with this one is that if you're investing in a fund that's paying a dividend, those are less volatile types of stocks. So it's not like Bitcoin, for example. They're just more stable. So if they're paying a monthly dividend, a lot of times those are more stable. So, and this next one is kind of the same. So those companies usually increase their dividends over time. just because they have growth and capital and they're able to hedge against inflation. Similar to regular real estate investing, I would say. Regular real estate investing is definitely a great hedge for inflation. Our favorite newer strategy for these types of funds is the potential to take loans against your own securities. So if you have $1 million into a fund, there's different platforms that will allow you to pull a loan out against your own money, but still pay you the same dividend. So say you had $1 million and one of them, so there's different Charles Schwab, Chase, there's a few different ones, and we'll go over those too, but different companies allow you to take different percentages back against what you've already put in. So if you have $1 million, Charles Schwab, say, would allow you to take 50% of that as a loan to yourself. And that's an interest-only loan, and the interest is a little higher. It's like, well, depending on how much you have in. But they would allow you to take a loan against that, but they would still pay you the same amount of monthly dividends. So they would still be paying you your dividends on $1 million, even if you have $500,000 of it pulled back out and you're using it somewhere else. So that's Miles is going to talk a little bit more about that. So we thought we'd hit on the bad parts too. They're not guaranteed. They're limited. They're limited in their growth potential because of the way that the funds are ran. So like Bitcoin or something like that, if you're going to invest in something like that, you have a pretty big swing, right? So you can make a lot, but you can also lose a lot with something that's going to be paying you dividends. They have to pay out most of their profits. And so it's going to be a very stable, much more stable, less volatile kind of situation, but you're also limiting the flip side of that is you're limiting the potential for it. So this is, so it kind of seems like a life hack to me to be able to have $1 million somewhere and then pull $500,000 out and still get paid on $1 million. But the potential problem with that is this yield trap. So you just have to be aware and watch for the drop in your underlying stock price, right? So if you bought in at $50 a share and you're getting those monthly dividends or quarterly dividends, what you just need to watch out for is that stock price, you're going to want to watch your stock price on it to make sure, oh, now my stock's only worth $40 instead of $50, so that's the potential issues. The stock price could drop too. So the other piece of it is in regular real estate investing, you usually have a tax benefit. You have your depreciation schedule, you have your interest write-off, and you can accelerate your depreciation. Like there's a lot of strategies for regular real estate investing that you can use for tax benefits. REITs are different. You get taxed. So your dividends are taxable, and they're taxable at ordinary income rates. So it's you're not getting any sort of benefit on your taxes by investing into REITs. And then opportunity cost, potentially missing out on higher overall yields for high growth stocks, more risky type stocks. So I think that's probably 6. So
Awesome. Well, I'm Miles. I'm Amy's husband, and I love this stuff. This is what excites me in the morning is stocks and stuff like that. So yeah, besides coffee number 1, and then this. So before, like, I never really got excited about REITs like before, because like I would learn about them but like the returns on them are like 5%, 6%. And it just wasn't exciting for me because we've been investing in real estate for a long time and we usually beat those returns in our real estate. And so I had a hard time. I kind of just ignored them. And I wish, knowing now what I knew, I wish I'd never ignored them because there's huge potential in them. And we'd be a lot further along probably had we not. So, but this is the exciting part of it. Does anyone who invests in real estate? You guys do. So anyway, I think this will be exciting then for you, maybe if you don't already do it or know about it. But does anybody have any questions about the REITs so far? It's kind of like millions.
Millions.
Oh yeah. Do we want to do any? Yeah, if you just have questions like about a REIT, like, yeah, ask now, and then we'll get further into it.
Buy or sell, how much do you have to hold them? And I was wondering about tax stuff that you just did. Want to know the difference between EFT and the REIT, and why one of them together, and man, taking out a loan that and like still getting paid on that.
Yeah, that's the hack, I feel. So
Just wait till you see the map, Angie. Very exciting.
yeah,
Very
yeah, that's exciting. Okay, well, we'll continue on because I think we'll hit some of those points. Go ahead.
Those APL and the O and the returns are like
Not
small.
not very exciting.
Yeah, and then
Yeah.
you not get the benefits of
Yeah,
your depreciation schedule and your interest rate off and.
sure why I'm as excited about this versus coming together.
Yeah.
I'm wondering what else we change. Yeah.
Yeah. So I also like other stocks. Like we don't just buy REITs or anything. Like we diversify between all of them. So, but REITs are typically stable, you know what I mean? And they hold their value. And so I think they do have like some value with that one. And I'll talk about specific ones that we bought and why we bought them. And maybe that'll help go through that as well.
I'm like usually when these guys are investing in real estate, they sell the property at some point. So is
I
that-
think you're thinking of a syndication. Yeah. I
Yeah.
think that you're thinking more where they're like, okay, we're gonna group all of our money together, we're gonna buy it, we're gonna reposition it, and then we're gonna sell out.
20 years.
Yeah. So this
Yeah.
one is like, you're just buying. You're
It's like
just.
general stock.
Yeah, this is just like stock. It's just like on
Yeah.
a brokerage. You put in the ticker and you buy them like that.
Okay,
That's
so-
the REITs.
No,
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 but that would be like a syndication.
like this is,
Mhm.
yeah, you're not, that's a syndication. Yeah.
Yeah, we can talk about some syndication too. If I was gonna buy a syndication now, I would borrow against my REITs and put the money into a syndication. Personally, that's what I would do, but like using this,
We'll
but
just
we can
strip
talk about
one.
that.
Like the map is just,
Yeah, it works good. But okay, so the simple answer, where do you buy REITs? You can buy them through any brokerage that you can buy stocks through, essentially. So you can set it up. Charles Schwab, Fidelity, Chase, Vanguard, Interactive Brokers, there's Public, pretty much anywhere you can buy stocks. And they're super easy. Yeah, you can buy it through Robinhood. And so anywhere you just set up an account and then you just have to decide which kind of account do you want to buy them in? Are you going to do like a taxable brokerage account or like a retirement account? The good thing about if you do buy it in your retirement account where we said like the dividends are non-qualified dividends and you have to pay the taxes on them. If they're in your retirement account, it would just go back into there. You wouldn't have to pay those taxes on it. So that might be a good way if you do that.
if you have a 401k or Roth IRA,
Right. Yeah.
your tax implications will be different if once you get to your retirement.
Yeah. But we we do it in a taxable brokerage account because I like to be able to have access to the money and use it now and do what I want. So that's how we've set ours up. But there's different reasons so the pros to the taxable brokerage account for us, like you have control of it. You can buy and sell anything you want, anytime you want. And
Sell whenever, like you could buy it today and sell it tomorrow, like it's very, it's not like real estate. Where you're like, hey, no, this might be 6 months, you know what I mean? To sell
Right.
it.
yeah, and so I like that. And easy access to your money without any penalty to it. No one's controlling it or like that. There's no contribution limit, so you can put in as much as you want. You can take out as much as you want. Ability to use it as collateral on a loan. That's the big one for me because if it's in a retirement account, you can't borrow against your retirement account. So it has to be in a taxable brokerage. And then you don't ever have required minimum distributions. So I like the freedom of the taxable brokerage account, but it does come with the penalty of paying taxes. The cons are taxes. And then another one is lack of creditor protection. Like typically your retirement accounts are protected. If you're ever sued or that, they won't be able to take away your retirement accounts. That's pretty protected. Where a taxable brokerage account would, if you got like a lawsuit or something like that, they are more vulnerable to being taken, I guess.
I think you went back.
Oh. Okay, so then I just have some examples of the real estate, the REITs that we personally hold, so that we can talk about them and our experience with them, because I think that's helpful. So O, Realty Income Core REIT, it's probably the most well-known REIT. They've been around forever. They're probably the biggest. They're known as the monthly dividend company. They were founded in 1969, and they have a portfolio of 15,600 properties. So like them buying and selling properties, it just happens like you're not informed of it. It's just happening like behind the scenes. They own it in all 50 states and 7 other countries in Europe. Since being founded, they've declared 661 consecutive monthly dividends, and they're a member of the S&P 500 and the dividend increase, whatever. And they've increased their dividend for over 30 consecutive years. So I like this one because one, there's just history on it. You can go back to it, you can search it, you can see that they're consistent over 30 years. They paid out this. So I have a lot of confidence in it that you're going to get that return, which their return isn't the greatest. It's 5.43, but it's consistent. You know what I mean? So it's a little bit more, but the off thing, and I love this one because it pays monthly dividends, because with real estate and all that, like all my bills are monthly. And so to get a monthly dividend is beneficial, I think. And then our experience with it, we've owned it for just a little while, and it seems accurate on their monthly dividends. Like today actually was the day that we got paid our monthly dividends on 2 of these. And so I ran the calculation, and that's right about where it is. It does fluctuate month to month. This month was like a little bit higher, but like 5.7, but it's going to be right there, pretty consistent. And then overall, like you can see that their current price, this is when I did it maybe a month ago when I put this together, their current price was 59, but their 52-week high, it goes between 64 and 50. So there's still quite a bit of variation in it per month. So the stock price goes up and down. From where we had bought it, it had risen like 3%, so you do get some over time, but oops, yeah, it's my pointer. Oh, I go the wrong way. And then another like popular one, it's not quite as big. Like, oh, if you go back here, you can see that they have $54 billion in assets. So it's a really big fund, and they have a lot of assets, but that's always helpful, like comparing between them. This one's a lot smaller. They only have 3 billion in assets. And this one does mostly like upscale, like hotel rooms. So they consist of 220 hotels. They have 29,000 rooms located in different markets. They're in 37 states. A lot of them are Marriott's, some are Hilton's, but they offer a higher dividend yield. So it's 7.61. So it's a little bit higher, but they haven't been around quite as long. They don't have the history of the O1, but I like the higher yield, and I do think that they're pretty consistent. And again, you can research it and see all their history and all that, which I really like, because sometimes we look into syndications and it's just hard to know on one property if that's going to work out, or if that's going to be a dud, or you know what I mean. And REITs at least offer a good variety, right?
It's fine.
Yeah, it's fine. But I do, and anyway, there's a few reasons. I'll talk about more about that. But our experience on this one, it's been accurate as well. Like every month we've got the same. Today's like came out and I calculated it out, and it was like an 8.2% return for the year. So it was a little bit higher than the 7.6, but at that return, tempting, you know what I mean? Like an 8% return, 7.6 is nice. And then it's the same thing, like their price changes in their 52-week high from like 16 down to 10. So there's quite a bit of variation. We've seen a little bit of rise in our overall value of the fund. But does anybody have any question on either of those ones or why we chose them? Okay, so here's the exciting thing, like how we're using them to increase our overall real estate investment returns. Yeah, go ahead.
Market cap 50 billion, 3 billion. You know, that's a far cry from like Blackstone, right? And all these types of things. So, was there any thought like, I guess maybe the question is, I mean, you said it was on the S&P 500, which I was like, maybe I'm just getting jaded by some huge companies there. That's still pretty big. I guess I'm thinking like, you know, I assume Blackstone always have a bunch of sub entities or sub REITs, still one giant REITs, or are they just simply Blackstone's more for a different type of investor, or these are more able to make chunky.
I
think that's not there.
What's that?
Maybe I'm just thinking about things that aren't actually connected.
Like, so you're thinking like Blackstone, like if you,
Like, you know, Blackstone is a giant investor. So, you know, why not at the Blackstone? Said what you know, like what you liked on the something like that.
I haven't looked into Blackstone like as much. Is that just like Blackstone stock?
I don't.
Is it a REIT?
Yeah.
Blackstone REIT?
It's a $1 trillion.
Yeah, I know. I know who Blackstone is, and they invest in single family homes, and they're huge. They're everywhere. I know that Blackstone, some of them I read on some funds, I don't have it like off the top of my head, but Blackstone buys with all of their money, they buy some of these other funds too. You know what I mean? But
I said it's they had like I'm sure they have like a real estate class.
oh, I'm sure. Yeah, they might, and they have a whole bunch of funds. The reason that I went with these ones is mostly because of the monthly dividends, because those come back to me. Like I have stocks and stuff too, which I really love, like just buying like the S&P 500 index, but like you have to sell them in order to get money out of them. And then if you sell it, you have to pay the capital gains tax. I like the monthly dividends just because it comes to me, and because otherwise I'm not going to sell my stocks. So these ones about a year on the REITs. But we've been investing in stocks for a long time. I've just barely like caught onto this strategy, I guess, and like using it differently, I guess. So and this is why. Is because like so at Charles Schwab, that's where we have most of our money right now. And like Amy said, they have a program, it's called the pledged asset line. Well, you can borrow up to 70% of the value of your equities. And it's a loan to you, so you don't get taxed on it. So it's just like taking out an equity loan. But all of your stocks that you have, like they stay invested. So you still get the upside in it. And if they gain, then you gain. The REITs, you still get paid the dividends to you, not to Charles Schwab. So that to us makes a big difference because, yeah, I'll talk about this first. So,
Maybe just hop onto the numbers real quick,
okay.
because it seems like that's where everybody wants to go.
Okay, I'll just say the highlights of it. So, well, I guess, did I cover all that?
What's your question? Mhm.
Yeah. So it is through Charles Schwab's bank. And then it's called like if you Google it, it's called an S block, which is a securities backed line of credit. And a lot of banks will offer it. It's usually through the brokerage where you have your funds. So it's important if you're going to use this, to set it up at a brokerage that will allow that. Charles,
The limit.
yeah. And
So if you go through Charles Schwab, they're 70. If you go through Chase, they're 50. So to know what's that? Yeah.
Vanguard, we were with Vanguard and I think I switched because they didn't have it. But you can switch it. It's pretty easy to roll them over, but I switched to Charles Schwab. But like Interactive Brokers is another one that loans really, their rate is a lot lower, but they'll only loan up to 50% of it. And Charles Schwab does 70%. And for us, that extra 70%, that extra 20% is a lot. So
If
we
you're
have it there. Yeah, if you're in growing mode.
Portfolio, that extra 20% could really give you a lot more
The
flexibility.
interest only that's paid back to the bank.
Mhm.
Yeah,
Maybe up against your credit.
right.
Right, because it's the loan against yourself.
Yeah.
Right.
And I love it because you don't have to like banks I love. I'm like, we've dealt with like a lot of them, but this way, like you don't have to talk to the bank or ask them permission. And so you just get it. And like Charles Schwab makes it super easy. It's just like I call them, I tell them, or you can do it yourself online, but it's like sending a wire and there's no questions asked. The wire can be there the same day with the loan once it's set up. The only thing with Charles Schwab is the first time when you set it up, it does have to be a certain amount. So I think it has to be $150,000 the first time you borrow to set up the pledged asset line. But if you went through someone like Interactive Brokers, they don't have a limit. And then like what I really like about taking the loan out too is like when I look back at like our real estate portfolio, like we have so much equity that we've paid down on like the principal of our properties, but you can't touch that equity unless you refinance it, and then you have to pay more fees and do that. Where if at least I had taken like our down payments and borrowed against them like this, you could it's it's instantly accessible when you pay down that line of credit is instantly accessible to you. And so that would unlock a lot of potential for us had we done it differently, I guess. I'll go through the cons. Like the dividends, they're never guaranteed, so you always risk like getting a dividend cut. But like I said, a lot of the companies have a history of being really consistent. So the interest rates on all the S blocks are variable. So they do the SOFR rate plus whatever percentage. And your percentages get lower usually the more money that you have with them. But if rates, it's good and bad. If rates drop, then your interest rate drops as well. But if they go up, then you got to account for that. Margin pressure, which is anytime you borrow, like, so at Charles Schwab, if you're right at your limit at the 70% and stocks drop 10%, then you have to have it totally covered. So they would call you and you'd have to either put more money to get up to their margin requirements, or they could potentially sell your stocks without telling you. So in my mind, you just don't push that limit. You know what I mean? Give yourself 10% below what your lending limits would be. And then double leverage, because REITs themselves are usually leveraged, and then you yourself are leveraged as well. So you're kind of double leveraged. So I think it's just your risk tolerance there, which. Okay, so then I just took this page. This is like straight from Charles Schwab's website. This is their pledged asset line, and it kind of like walks through it. So like when you have $250,000 interest rates, they'll give you like a 25% discount. When you get above $1 million, they drop it like half a percentage. And then this is their rates, you know what I mean? So from 100 to 250,000, it's a SOFR plus 4.4. The SOFR, you can just search it. Like if you just search the daily rate for today, it would come up with whatever, and then you would add it. So you would know their interest rate. I think this is a little higher now because it's come down. But once you get like above $1 million, it drops quite a bit from there. So I don't know. So the rich just get to borrow money really cheap, So yeah, so you can get it down to about like a 7% or so through Charles Schwab, but they are a little bit higher than other banks. Like Chase Bank offers it as well, and they're about 1% to 1.5% lower, but there's some trade-offs with them as well. So an example, I just came up with like a simple one so you could kind of see the math of what the potential is and why, like for your clients or investing in real estate, why it could be beneficial for them. So I just took like, just to keep it simple, just a traditional 30-year mortgage at 5.5% at like a $300,000 loan. Your payment's going to be $1,700 a month. 1,300 of that is going to be an interest. Principal is 328, and say you're getting a rent of $2,000 a month. Very rough numbers with no capex in there. You're like, this is just my basic cowboy math. Yeah, like yeah. So you get like 297 a month. Like when we were looking at properties, I'm like, that's great. If you're cash flowing, you're doing something. Yeah, it'd be great. So, but then kind of using the same strategy, but say you have all this money in a security backed line of credit that you could take. And I did it with taking all of the money, taking off 300,000,
Like,
just so you can see the math of kind of like what it would, and that even if you did it with just your down payment or something like that. For me, looking at our properties, like we pay so much money just in here, like in interest per month. You know what I mean? I'm like, that is a lot of money to pay. And, like a lot of our loans are back at like 4 or 5%, but we'll pay a lot in interest a month. I'm like, what if I could just get that money, if I didn't have to pay that interest payment per month, I would make so much more money, or I could keep that in my pocket. And this is the only way the best way that I think that I found to eliminate your interest expense
well,
safely, lower it. So using the SBAC, say you could get like a 7% yield, that may just an average. You can put it into other things, but if you're getting that 7% yield with the same $300,000 invested, you'd have to have more than that invested, obviously, because nobody loans you up at 100%, right? But the calculations is just on the 300,000 invested. So your payment interest only on that 300,000 at 7.95%, say that's what you borrowed it at. So that's what Charles Schwab or whoever you borrow from, if they're charging you an 8% rate to borrow your own money, you could get that way lower. I think that's on the high end for wherever you go. Then that payment to the Charles Schwab would be $19.87 a month. That's an interest only payment, right? Okay, so the rent would be $2,000 a month, and then your dividend payments that you get on your 300,000 at the 7% would be 1,750 a month, which you continue to get even though you've borrowed against them, right? And so your cash flow in this scenario would be 1,763 per month, but I do it with a huge caution because that doesn't include any principal pay down. You know what I mean? So you could calculate in how you're going to pay that loan. But overall, just your rough cash flow, you'd get a lot of money, more money back, which is essentially covering like your interest, if that makes sense.
to reopen the can of worms there.
Yeah, that's. Question is helpful.
Yeah. And this is like what I didn't understand of why I should buy REITs. And then when I look at it, I'm like, oh, okay, well, if you're making a monthly payment, you're getting that, then it's beneficial.
Invested. And then you can borrow against that money and you still make a cash flow on the money that you had invested. So like, for example, at the beginning, if you have $1 million in your fund, you can borrow, say half of that, you can pull out 500,000, and then you can go use that 500,000 to buy real estate, and you still get your dividend payments on $1 million. Even though you still have $500,000, you have $500,000 of that back in your bank account, but they're still giving you dividends on $1 million. So your dividend payment doesn't change, but you can take that money and you can go reinvest it into real estate. And it, right now, I'm sure the real estate investing is the margins are pretty small right now, so.
You utilize that probably for not long hold. Like, you wouldn't necessarily want to be holding a $500,000 debt only unless you have like strategy to pay that off. So
Yeah.
Right.
Right.
careful whether you have another finance it, or you're doing a rehab, flipping, or doing somewhere where it's not the long-term plan to hold that $500,000 in that capacity.
I don't know.
Yeah,
You
well, for me,
There's 1,700, so, and plan to pay back, so you're paying your interest
That was
only.
a long time at
So-
1,700 to pay off 5 grand.
Yeah, but it's the same. I mean, you pay out of your other loans over 30 years. You could do the calculation of how much to pay per month. You know what I mean? To get to like in here, your principal is 328 over a 30 year. You could take, you know, even if you took 700 or you could take 1,000, your cash flow is still higher and you would still pay that off faster than a 30 year. So yes and no, but also if you can borrow at rates at like 3%, then I mean, it's how risky do you want to be? But if you can borrow, then if you can refinance this property at 3%, then I would refinance at 3%. I would pay off this loan and hopefully put more into securities. And like what was I gonna say? Yeah, but I like that, like this, anything you put down on it, you can pull back out instantly. That line of credit's right back to you. So where a 30-year loan, you pay that down. The only way that you're going to get that out is to refinance that property with a, yeah. And then you're paying more fees again to refinance that, and you have to get approved. So I like this because your money is easily accessible. So me and Amy used it. We bought a business in Florida. And instead of just paying cash for that, we borrowed the money from ourselves using this. And then, yeah. So, and then we still get paid per month on our dividends. And so instead of financing it through a bank, I still make more money than I would have borrowed it at.
You guys
There,
are-
there like a minimum amount, segment, then.
Depending on who you go through for it. So with Charles Schwab, yes, you had to borrow the first time. It's about 150,000.
An actual investment, like a minimum investment for a REIT.
Oh, for a REIT, no, you can put $1,000 into it. You can buy it. Like a lot of them will cost like $20 for the share.
Well,
It's
depends on the platform. So like he was saying with Charles Schwab, you had, when you did your first pledge asset line, you had to take out at least 150
mhm.
for that.
But
Like full life insurance.
It's very similar.
Very
Yeah.
similar.
yeah, see, that's I looked into whole life insurance. I like it, except that you have to pay every month. You know what I mean? Like I see it as an expense. And if I ever went to whole life and I'm like, cool, I gave you guys $1 million. Can I just have my $1 million back?
They would
Like,
make you
no,
your money
you have to die
back.
to get that back.
It is your money, you just can't take it back
Yeah.
into your own big.
And so this, you have access to all of your principal and everything, but maybe I don't understand whole life. Yeah, because every time I look at it, I'm like, it seems really, really good. I'm almost there, but I can't get there. And so, but this way, I think is kind of like all the benefits of whole life, more flexibility. You have total control of it. You can do anything you want with it.
And you don't have to, I mean, yeah, you don't have to take out your monthly thing.
Yeah.
Okay, so what about this option versus if you have 600K or $1 million in the bank, you can get a mortgage for 300. You have that much money. What about just taking the 300K and paying off the mortgage and not having to pay the interest?
Sure.
So I know you're not getting the dividends of 1750, but then you're not paying 1987 flat.
Mhm. You're just talking about whether or not you can use, like, that's
Like-
wrapping your brain around using leverage. Like that question to me is like, because we've had that discussion in our, we have like 40 I think doors now, so like over the years, we're like, cool, so then we start paying these off and then just take the cash flow from them. But it just depends on where you're at in your portfolio, your risk tolerance, what do you want out of that portfolio? If you're like, I'm a super safe person and I don't really want to deal with like where the markets are going or what interest rates are, then surely go pay off your home and you make that $2,000 a month and then you just have to cover whatever problems arise on that property for the next 20 years. But if you want to grow, if you're in growth mode, you're always limited by capital. I don't care who you are, like you can be Blackstone, like you're always limited by capital. It just depends on what you're trying to buy. And so for us, we're still in growth mode. That's like, I want to be able to buy 3 properties or 4 properties or a commercial building, or like, I just want to be able to buy more of them instead of just holding just the one. And I would say that probably is maybe a
Big, yeah.
difference. So
Oh, I skipped one, sorry, because this might help as well. When I think about it like that way, like we could have bought our business, like we had the cash, obviously, like I could have sold my stocks and bought it in cash, right? But I wanted to keep my money invested in the market because you get that potential of growth as well. And you're still making the money. So if I can borrow it from myself, if I'm making monthly, if I get the monthly payments so that I can always make those interest only payments, I'm essentially paying no interest. But if say like I bought my business now, like I want $300,000, I would have to go to a bank to give me that money or get a loan on that, if that makes sense. So, but this way, paying it down, I still get all the benefits from it. Also, as I pay it down, I have that line of credit instantly accessible to me. I don't know if that helps, but this is one that I also like, but this is that mortgage REIT. So the other ones were actual equity REITs. Yeah.
like making loans to each other overnight and then paying it back. And it's really,
Yeah, it's leveraged. So this is called AGNC. Their market cap is 10.9 billion, so it's not small. They've been around for a while, but they provide capital to housing markets. So essentially they buy mortgages that are backed by Freddie Mae and Freddie Mac, and they leverage that and buy more, and they make a return on that. And then they're still considered a REIT, so they pay out 90%. They also do monthly dividends, but their rate is 13.9% monthly. So it's almost double the other ones. And so I bought both of them because this is a little bit riskier. I balance it out with like, oh, that's more stable maybe. But these guys also have a really long history of paying that. But they're affected by mortgage rates, whether they go up or down. And so there is a little bit more risk to it. But our experience so far is that they've been accurate. It's been paying out these monthly dividends at this rate. They do fluctuate as well because there's more uncertainty around it, whether rates are going up or down. It changes their price. Our last payment was higher. Like when I get the monthly payment, I calculate it out to see how accurate it is. It's my favorite thing to do. And it's like a 14%. So it is, but that's a lot more money. So when I look at that one, then I'm like, well, that's way more exciting because that changes everything versus a 6% to that one. Your cash flow goes up significantly per month. And if,
double.
yeah, and yes, this one's still borrowable. And like all of that in that pledged asset line, they'll lend up is your whole portfolio that they consider. It's not just a REITs. It's like if you just have in the S&P 500, they borrow against that as well. So you can pick and choose your stocks within it. There's also some crypto ones which they group them in too if you want to get wild.
Super high risk, super high reward.
Yeah.
That was a question I think, but like with the line of credit, like it's not just for REITs, but it can be like stocks and everything.
Mhm.
Like,
It's like your whole portfolio.
do you try and like use a mix of both when opening the credit line, or do you focus on just using one?
So I used to like my whole philosophy was just to buy the S&P 500. That's all. Like I'm just like you don't beat that return. Usually hedge fund managers don't beat it. So I would just always buy that. And it's just like within a year or so that I started looking, but those are hard because if you loan against it, then you're not going to make that monthly interest only payment because you'll have to sell your stock. You have to sell your stock to make it if you're just doing it that scenario. So the only way that changed my mind on monthly dividend ones was like I could buy them. I get a monthly dividend. I get more monthly dividend than I borrow against, and so I can just pay that monthly interest only payment just off my dividends.
line of credit, if you're using the REIT, you're getting the dividend with like, so it's nice because you're making like more money or whatever, but if you were to use that stock, then you probably wouldn't be making as much, so it might not be as. Compared to that one, which was would be getting dividends.
Yeah, and not
Listen-
the stocks pay a dividend.
Not all.
So that's the
Right.
challenge.
Yeah, and usually like stocks, like on if you just buy the S&P 500, you do get like a dividend. It's usually quarterly, and it's like a 1.7% on the S&P 500. So it's not very significant. You're never going to make an interest only payment on it, but you could borrow against it, and then if you wanted, you could sell them, but that would open you up to capital gains in that.
Yeah. Okay.
Does that? Yeah.
Your experience, at what point would you say be good to invest? It seems like a lot of this that is to Canada. Which is just what I mean, at what point would you say it's a little bit like what's it like $20,000 that you can do because that's like a minimum down payment? What would you suggest?
Well, do you invest anyway? So like you have real estate investment and then, do you diversify as well? So you're
Yeah.
investing and picking those, other
but
things.
I'm definitely
You're
not
just-
like the, hey, put in 500,000 and then.
Yeah.
Sure.
Yeah, that's what I think is the hardest part about it is like it's painful because you have to build it in to be able to borrow against it. But like when me and Amy started, like we just worked as nurses at the hospital before Amy went into real estate. And if you're going to be investing in real estate, then I would just start doing it, and I would do it smaller. Like if it was 20.
I just did a ton of like.
Oh, well.
That's fine.
I didn't mean to like knock on it. Like it's definitely a vehicle.
This to potentially borrow for that purpose. I like the idea of the tax purposes on the whole life insurance is a lot better because it's totally tax free.
Well, this is tax free too. You borrow against this, tax free.
If you're borrowing.
If you're borrowing.
On your dividends. So but it's like you're
Whole life
taking out
insurance
debt.
dividend are tax.
Yes.
Yeah, because it goes back into the vehicle. But yeah, I agree with it.
And I will say too, it's all dependent on how those are set up, right?
Yeah.
So when they're structured, a correct policy will give you 80 to 90% access to the cash that you're putting into them. But
94.
But the challenge is that
Mhm.
most people who are selling those policies, they're benefited by the lower your cash value is for the first 7 years of that policy, the more they get paid on their commission. So they're incentivized to structure it, unfortunately, the wrong way. So that's where you have to just be very careful on how they're getting set up to ensure that the majority of your cash is going towards the cash value.
And I would just say, like, if I went back in time, like the first times when we saved up like our $10,000, $20,000 for the down payments on our homes, if I had known, I would have kept it invested and borrowed it. Yeah. So, but it would have built slowly over time. And just in my properties, we would have more equity accessible to us. So it just would have built this a little bit faster. But
Trapped. I mean, like right now you just have, and it's just, sometimes it's just hard to look at just because you're paying so much in interest every month and you're like, man, if you borrowed the down payment and then paid that back over time, then all of a sudden you just have, you've just got a little more leverage.
yeah, it's like if you're in real estate, you're gonna have debt. Well, the way that I approach real estate is I'm always going to have debt. You know what I mean? This is just a way for me to be in control of that debt instead of like a bank. You know?
That went a lot longer than we thought. I thought
Yeah, sorry.
Done in like 15 minutes.
Yeah.
That was good.
We're gonna be done with this so early. Time for questions.
Thank you.
We have all the questions throughout.
Yeah.
Are there any other questions?
I'm sorry. You already covered this, so.
You're good.
I was asked one question about the down. You know, 300 grand instead of buying a. So I just. Numbers still work out pretty similar to these. I mean, obviously negative.
Well, maybe
It-
not.
Yeah, it depends what you're like invested in. So in mine, like that's why I've never done that because I'm like, I've never financed my down payment because it changes the numbers and makes it so it doesn't cash flow. And using this, it doesn't, as long as your interest rate is higher than, those monthly payments, as long as you're getting more on whatever you're invested in, then you're paying in interest, then you're going to be better off. Then you're actually going to be cash flow positive.
And it's really an arbitrage play because
Yeah.
let's say that your interest is 6%, 7%, but you're earning 10 or 13, you're earning 5 or 6, 7% more on that capital. So you're really double dipping.
Yeah.
Back security, their whole platform is based on like, I'm gonna give you, they're winning on a spread. Like they're lending at this and they're buying back at this and they're making a spread. So it's exactly, it's just, yeah, it's an arbitrage play.
And say like, even you thought this was risky or these were risky, I would still do it if you say that like bonds are like the most secure thing, you know what I mean? And you can get a bond that it can pay you 3-4%, then essentially I would still borrow against it, because even if I'm paying like a 6%, but I'm making a 4%, my essential interest would only be 2%. Does that make sense? So you're still saving, even though you are paying more, you're still better off if you can borrow against it yourself. And then you'd be ultra secure.
Okay, so doesn't make sense to me. For everything, you have to pay that HELOC off.
Yeah.
But you're making dividend.
But you're making it
Yeah.
dividend.
And that changes it. With the HELOC, every time I've
Yeah.
looked into the HELOC, I'm like, how is that gonna, it doesn't cash flow. It's not gonna work. Yeah.
That's not-
Yeah.
Yeah.
Please, go ahead.
So I don't know if this would be fun to hear, like how you leverage this and how many like properties you have and where.
We all want to know about your
Oh.
portfolio.
Our portfolio.
Like,
Like here, how, yeah.
Oh, yeah.
yeah,
Well,
this is relatively new for us.
yeah, this is,
Built just over 20, 15-ish, we really was when we started to invest,
Yeah.
but.
So,
we didn't- But like, when I got into real estate, like Miles said, we were nurses for a long time and, when I started doing real estate, I did it so that we could save that money. So we were putting away quite a bit when we were young, before we had kids we were thinking to maybe have 5 properties paid off by the time we were retired. And then when I had my second son, I was doing the finances and I was looking at this and I started reading books, and I think Bigger Pockets came out around that time. And I started listening to Bigger Pockets, and we just bought like a nice house, like 320 or $340,000 house. And that was like a really nice house for us. And I was like, we made a huge mistake. We've got to sell this house. Like, we need more rental properties. We gotta get out of there.
we had to house hack them all because it was only like a 5 or 10% down payment, which was just like,
Like trying to scrape by
Yeah.
anyway. So then I had my second son. I'm like, I'll get my real estate license and then we'll keep buying properties because I'll just get the commission back on the one that we bought. And then I went down a rabbit hole, real estate investing, and just went totally bonkers with it. And I just loved it. It just made me very excited. So then we just continued to build. So everything that I made for, I don't know, probably the next 10 years.
yeah,
We bought close to it. So we have close to 40 doors right now. So I just exchanged into that. So we did an exchange just recently. One of our fourplexes in Florida into that commercial building. I don't know if anyone, some of us, but like, so we bought a commercial building on Lehigh Main Street. So I don't know that doors wise, we went up indoors and we're a little higher. than that,
yeah,
But
but
they're all in the same building. So, anyway. So we haven't used this, we used it
yeah,
to pay off, we have some condos up in Ideal Beach, in Bear Lake. And the HOA is horribly managed and so,
and the bank, like we had it financed and then the bank came back and they're like, it was a 3-year or 5-year lock. Anyway, that time came up and they're like, hey, your rate is resetting. And it was resetting from like a 7, or it was a little bit high. It was maybe like 5 or 6, very reasonable, going to like 11%. And it was a commercial loan, and then they were in a lawsuit, so we couldn't refinance it. And so they wouldn't refinance it.
it's a straight choice in a lawsuit, 2 lawsuits actually. So then they would refinance, so we just hold against.
So I
it.
said, cool, I'll just,
So yes, there
I
are
can
some
borrow.
scenarios where you're like, all right, well, I'm just gonna take that and pay it off, I guess, and so you're still leveraged, but.
Yeah, so it was super, and then all the benefits were like apparent to me because I didn't have to talk to the bank. It was my own asset. I couldn't get it financed because they were in a lawsuit anyway. So we would have been in a pretty difficult place otherwise, but we had this. And so,
It is horrible every time. I
Yeah.
know, even if you're working with a lender, like by this time, you're like, I am not going to any other lender because this guy has all my stuff. Even at that point, you're like, it's just horrible. to
Yeah.
go.
anyway, and so how we're using it now, like I would refinance all of my properties like as soon as possible. And I would equity strip and put it in here and do that. But
It doesn't make a ton of sense right now with it.
but yeah, rates are really high. But
I'm a high risk, he's a low risk person, except for
Except-
Bitcoin.
yeah.
I'm saying Bitcoin. Bitcoin is the only thing in my life that's like,
Yeah.
I'm all in.
Me, like with this and leverage, I have become a more high risk, like, because like I think some people would see that other AGNC as like 13%, and like maybe it is high risk. Like I don't know, you know what I mean? I'm willing to try it and find out based on the history of it, but depending who you talk to, they might say that's really risky. But also there's like I invest in some other funds too that give like 15%, like they do like covered calls and stuff like that. And I think
They're returning 50%.
well,
That-
no, not the covered calls one, but yeah, if you want to get into Bitcoin, I don't recommend it. I know that it's super risky, but I'm willing to take like 5%. You know what I mean? Like we're at a spot where like I can take that risk and see, but those ones will return a lot. And so I've gotten more risky as far as this is concerned, I guess, but knowing that I'm okay if I lose it. Yeah. Or more aware. Yeah. But I wasn't, yeah, that's it.
Awesome. Give him a hand. Thank you. As we wrap up, I just want to get maybe 2 or 3 shares, just show Amy and Miles some love, some things that you guys picked up in this session today. What stood out to you?
Building gap. And so I don't, we don't have possible kind of. Right, too, but it's kind of about like scaling up. There's kind of this one little hole where the guy is like, I don't have enough money yet. What do I do? So this is a big gap for it, but
Yeah. I think that's
you know, so
yeah. That's the foundational principle, I think, we have to shift our psychology to say that like we are investors. Like you have to have that through the lens of I don't need to earn money to become an investor. I can invest if it's $5 a week. Right. So just get in the habit, the routine of saying, hey, when I earn $100, I actually don't have $100 to spend. I've got some set aside for taxes, and then I've got some set aside for investing, and then I can spend whatever's left. So come up with that criteria of what is that percentage that you're going to set aside that is your investment funds that's going towards that long-term goal that you have of financial freedom. That's the best habit routine that you can build for sure.
I don't think I wanted research to know if I could do it, but I feel like it's approachable. I have enough information now. I can go do a little bit more digging and searching for myself, but I wouldn't have opened the door. And I'm doing my thing. I don't think that. So thank you. It broke down like all the pieces, the pros and cons, and made me feel safe to learn. Maybe not we'll do it today, but sooner than 10 years from now.
Awesome. One more. Amy?
Say SPRC.
I've always read it, so I call it a spot, but that's me.
Yeah, I didn't know about those. It's just some big ideas. I'm kind of like into like, now I have a big picture. Think about if I can That's just like really helpful overview. And that's the whole. It looks like Apple. Yeah, look it up. So I just, it was a really great overview.
Yeah, it's awesome. One thing I want to highlight that I just realized, which I appreciate for you guys, is wealth building is a sport, and every sport has rules. It has, a different language, and they also have a way to keep score. And it sounds like from everything we went through, you guys understand the rules, right, of how to really just build wealth. But also you have to, with every different asset class, there's different language terms that you just have to study and be aware of. Just like soccer versus football versus baseball, they all have a different language. And then there's a way to keep score. And it sounds like, Miles, you keep score pretty well with analyzing, right? Am I winning with this type of asset? And how is it comparing against something in my, in my portfolio? But overall, I think the one rule that was prevalent is that diversification is a must, right? So it's not going all in on one asset class. It's saying, what are the 8 to 10 different assets that I need to have in my portfolio? Long-term, it's a principle from Ray Dalio. And one thing that actually brings me to the question on BlackRock, just to be aware, with REITs, there's also management fees. And that's probably the number one thing you want to also pay attention to. Tony Robbins has a book called Money Master the Game. And he wrote one that's more condensed called The Holy Grail of Investing. But he talks about fees, management fees for either funds or REITs, any kind of asset classes where there's an overall management fee, and you want to be aware of that. BlackRock's, I just looked it up for their REIT. It's called Bright, and their REIT is it's 2.12% management fee plus a 3% kind of carry cost overall. So compared to a standard where it might be 0.12% to 0.7%. So BlackRock's is almost 20% more. Theirs is also a private REIT, and so you have to be an accredited investor to get access to it. But just those are some things to be aware of, and just say how much, because the fees. This is the important part I want to hit on. Every 1% in management fees that you pay erodes 10 years of your retirement income that you're going to receive. 10 years. So for every 1% additional that you're paying in management fees, you can say goodbye to 10 years of dividends in retirement. Okay. So that's how important it is to just pay attention to what fees you're paying in any kind of asset that you're investing in. So awesome. Thank you too for showing up today. This is great. Gave us some perfect understanding of this, and hope you guys come back to our wealth building session for next month. They're always towards usually the end, but have a great week, and we'll see you soon. Thanks all.